Welcome to the Explainer. Today, we're taking a really sharp, analytical look at a company sitting right at the fascinating intersection of artificial intelligence and consumer finance, Upstart. Now, if you've been following the market chatter lately, you know there's this massive central tension surrounding this company. On one hand, you've got their current financial reality, which is definitely showing signs of massive growth, but it's also grappling with some persistent profitability challenges. On the other hand, you've got their future thesis, right? This bold, totally disruptive vision of using AI to completely upend the traditional credit scoring model across literally the largest debt markets in the world. And hey, if you've ever applied for a loan or a credit card, you're actually a part of this exact ecosystem. So in this explainer, we're going to dive into the hard data from their Q1 2026 results to separate the hype from the reality and see exactly where this company is headed. Okay, let's dive into this. Here's our roadmap for today. First, we'll look at Upstart's Q1 2026 results. Second, growth versus net losses. Third, the personal loan ceiling. Fourth, entering auto and mortgages. And finally, we'll wrap up with the long-term outlook. So starting off with Section 1, Upstart's Q1 2026 results. Before we get into the complex strategy, we really need to ground ourselves in the raw, high-level metrics driving the current market buzz. Take a look at this number right here, $3.4 billion. In just the first 3 months of 2026, Upstart facilitated roughly $3.4 billion in total loan originations across its marketplace. That is a massive 61% jump year over year. To put that dollar amount into perspective regarding actual consumer reach, we're talking about over 425,000 individual loans originated on their platform in a single quarter. That alone is a 77% increase in volume from the exact same period last year. So the sheer volume of transactions flowing through their AI models is just accelerating at a breakneck pace. And as you'd expect, that immense transaction volume translated directly into a powerful top-line revenue figure. Upstart pulled in $308 million in total revenue for Q1 2026. That marks a highly impressive 44% top-line increase compared to Q1 2025. It's super clear that the demand for their platform, from both consumers looking for credit and the more than 100 banks and credit unions using Upstart's AI models, is incredibly robust. On a purely growth-focused basis, these numbers show a company executing its primary marketplace function at a very, very high level. Moving right along, Section 2, growth versus net losses. Now, what's really interesting here is that top-line growth is only half the story. Despite that massive 44% revenue jump to $308 million, the bottom line reality is pretty stark. Upstart reported a GAAP net loss of $6.6 million for the quarter. And actually, that loss widened compared to the $2.4 million net loss they reported back in Q1 2025. So as the company is pushing more volume through its pipes than ever before, the actual cost of operating the business and acquiring those borrowers is, it's keeping them in the red. But peeling back the layers and looking one step deeper into their operating metrics, their adjusted EBITDA actually dipped slightly to $40.5 million, down from $42.6 million a year ago. That squeezed their margin from 20% down to 13%. But hey, it's not all negative on the operational front. Their contribution profit, which basically measures their core profit margin on the loans themselves by subtracting the direct costs of acquiring and verifying borrowers from their free revenue, was actually up 34% to $137 million. Plus, get this, 91% of their loans are still being fully automated end-to-end with zero human intervention. Zero. This impartially tells us that while overall corporate profitability remains a bit elusive, the core unit economics of their AI lending engine are absolutely still highly functional and scaling incredibly well. All right, let's jump to Section 3,
The personal loan ceiling.
So why the struggle for true profitability? Well, for decades, consumer credit has been entirely dictated by traditional credit bureaus, your Equifax, TransUnion, Experian, relying on relatively simplistic FICO scoring models. Literally a system invented way back in 1989 when people were still renting VHS tapes. The entire thesis of Upstart is that their AI-powered algorithm, which analyzes over 1,000 different data points, is simply a superior, much more accurate way to evaluate creditworthiness today. And the data largely backs this up. They can approve more borrowers at lower rates. But here's the catch. Despite having this superior technology, Upstart has been largely relegated to just one specific corner of the lending world, the unsecured personal loan segment. Why is that a problem? Well, consider this absolutely staggering number, $18.8 trillion. That is the sheer scale of the total U.S. consumer debt market right now. It is an almost unfathomably large pool of capital. But the reality is, Upstart just hasn't been playing in the deep end of this pool. And this brilliantly illustrates the issue. When you break down that $18.8 trillion pie, you see exactly where the real money lives. A massive 70% of total household debt in the US is tied up in mortgages. Another 9% sits in auto loans and 9% in student loans. That leaves just a 12% slice for unsecured personal loans and other minor debt categories. The unsecured personal loan sector that Upstart currently dominates, and where it generated the vast majority of its $3.4 billion in Q1 originations, is just a tiny fraction of the overall debt market. They have effectively hit a ceiling. To justify their long-term valuation, they absolutely must break out of that 12% slice. Upstart's actual loan counts for Q1 2026 show us exactly how hard they're hitting this ceiling. Look at this. They processed a massive 410,854 personal loans. But check out the other categories. Just over 12,000 auto loans and a mere 2,300 home loans. Even with their undeniably superior AI tech, they are barely scratching the surface of the massive housing and auto sectors. The legacy lenders in those big-ticket spaces are traditionally very slow to adopt new technologies, and that has historically bottlenecked Upstart's total addressable market. Which brings us to Section 4, entering auto and mortgages. So, the crucial point is that this strategic pivot is where the story gets incredibly interesting. Upstart is aggressively trying to conquer those much larger slices of the debt pie. While those auto and home loan counts looked really small just a moment ago, the growth trajectory is explosive. Personal loans grew a totally respectable 50% year over year to $3 million. But auto originations literally quadrupled year over year, hitting $263 million in the first quarter. Mortgage originations are also showing rapid growth, reaching $143 million. This absolutely proves that their technology is successfully migrating out of the personal loan sandbox and starting to gain some very real traction in the much more lucrative, big-ticket collateralized lending markets. This strategic pivot is being spearheaded by co-founder and new CEO Paul Gu, who actually stated in the earnings release, "The application of AI to credit is an unambiguous win for consumers, and we're proud to be leading the way." Gu has made it super clear his focus is building a high-growth, capital-efficient business, and they are taking bold structural steps to get there. In fact, to further fuel this expansion and remove friction from their lending marketplace, Upstart recently applied for a national bank charter. If approved, that charter could fundamentally change their cost of capital and their ability to originate these larger auto and home loans nationwide. A huge move. Finally, let's look at Section 5, the long-term outlook. We've seen the Q1 data and we know the strategic pivot. So looking at how this all builds into their financial guidance, for the full year of 2026, Upstart expects to hit approximately $1.4 billion in total revenue. They project an adjusted EBITDA of roughly $294 million, which would represent a much healthier 21% margin. But really the most important metric here is management's aggressive target of a 35% compound annual growth rate for total revenue between 2025 and 2028. Let's be real. You simply do not project a sustained 35% growth rate at a billion-dollar scale unless you are highly, highly confident that your expansion into those massive auto and mortgage markets is actually going to succeed. And that leaves us with the ultimate question for anyone analyzing this space. Can Upstart's AI successfully conquer the $18.8 trillion housing and auto markets? The Q1 2026 data shows us a company that's undeniably growing top-line revenue fast, but still paying the price for that growth on the bottom line. Their legacy personal loan business is strong, sure, but limited. The true test of Upstart's future thesis, and ultimately their long-term valuation, will depend entirely on whether that 400% growth we just saw in auto loans is just a brief spike or the beginning of a massive technological shift in exactly how Americans buy their homes and cars. Thank you so much for joining me for this explainer. I hope this slide-driven deep dive has given you a clearer, much more structured understanding of the realities driving Upstart today.